I'm Greg Hunter. Welcome to USAWatchdog.com. With us, economist John Williams at shadowstats.com. John Williams, thank you for joining us today from California.
Thank you for having me, Greg.
Well, I've been reading in the paper this week that retail sales, this was in USA Today, that they were up, 3.5%, something like that. But I read your reports, and it's like the tale of two worlds here. The president says that if you're talking, if you're saying the economy is bad, that you are peddling fantasy or peddling whatever it is you're peddling a dream. What is your read on the economy? Your report says that we have a recession at hand.
Well, if anything, the government's peddling fantasies. I'm not quite sure where that report came from. I suspect they're talking about the holiday season, which is a big shopping season, the biggest November, December, the biggest months of the year for retailers. They sure weren't up 3%. In fact, last year you had a collapse in December, and going against those year to year, looking at November and December and adjust for inflation, you're looking at something a growth below 1.5%, which you never see outside of recessions. In the official headline reporting from the government on retail sales, the total retail sales were down 0.1% in December. They were up something like 0.2% in November, but again, that's before inflation. We're not seeing much inflation in terms of month-to-month change, but it is picking up year to year. There's nothing there for people in the retail industry to be celebrating over. In fact, I'm not hearing too many people celebrating there. I think that was just a puff piece to try and boost consumer confidence.
Well, all these other, brick and mortar stores. Macy's laying off tons of people. Sears isn't doing well. Yes, the online was up, 6, 7, 8%, something like that. But that's not enough to make a holiday season. That's still a fraction of what brick and mortar is. Is it not?
The online is included in the government estimates, so there's no surprise there. It just isn't happening now. Granted, retail sales are looking better than industrial production, but if you look at retail sales, you're seeing patterns of growth here that generally you do not see outside of recession. We're not getting quarter-to-quarter contractions at the moment. I think the fourth quarter, when it's adjusted for inflation, will actually be flat versus the third quarter. That doesn't happen in healthy times. The first quarter of last year actually was in contraction. You had a miserable time, and a lot of that was blamed on bad weather. Now we have supposedly good weather that's boosting things. We'll have to see how that goes, but there are a number of factors here that are showing recession. Number one is industrial production. You can't ignore industrial production. Along with retail sales, it's usually used in timing formal recessions. It turned down starting last December and generally has not looked up since. You did have a little bump to the upside in the third quarter, but you've had 3 out of 4 quarters in the last year contracting, and the numbers that came out for the fourth quarter in December this last week or so showed year-to-year contractions that you never see outside of recession. This is typical of a formal recession. You're seeing recession elsewhere in if you look at the housing numbers, they've turned down quarter to quarter for the fourth quarter. We'll get some confirmation on that shortly again for the full quarter with housing starts. But that's a major sector in the economy, very volatile in its reporting, but that should be down for the quarter. You look at the stock market, look at the S&P 500 and the revenues that are being reported there for companies. We've seen for some quarters now that on a quarter-to-quarter basis, adjusted for inflation, and with some adjustment for all these share buybacks that the companies have been playing with, that the revenues for the S&P 500 are falling off quarter to quarter. You never see that outside of a recession. That's never happened. That's a broad measure of economic activity. So that it's you have a variety of indicators there. The estimates on the fourth quarter GDP, which will be published the end of next week. The estimates have been dropping. The Atlanta Fed, which has a pretty good model of what the Bureau of Economic Analysis is doing, and they come out with their headline GDP number. Their number for the fourth quarter has just dropped to 0.6%. They may not get that negative for the first reporting, but I think you'll certainly see that negative in the second reporting. And considering that we had at least initially a contraction in the GDP first quarter of last year and all these other factors coming together, I think you'll have an early call on a new recession, or at least what will be viewed as a new recession, in the early part of this new year.
Now, the Fed certainly must know this. I mean, they have hundreds of economists. They have lots of people working on this. Do you think that the Federal Reserve is going to come back and say, okay, we're going to raise rates again in April, or are they going to cut that back? I mean, they're talking about negative rates at banks in Canada as the oil market implodes in Canada, and it's imploding in the U.S. as well. Do you think the Federal Reserve is going to raise rates, and do you think they may cut that quarter point back?
That remains to be seen. It really doesn't have too much to do with the economy. All the Fed hype about, we're doing this to stimulate the economy was a canard. There's very little the Fed right now can do to help the economy. Actually, raising interest rates probably helps some because it enables banks to build a little more profit margin into their lending, which enables them to lend to the lesser quality or the higher risk loans. Anything that'll stimulate lending generally be a plus for the economy. If you can get interest rates higher, people living on fixed incomes can start to get a safe return again on their money rather than being forced into a very speculative and dangerous stock market. But what the Fed did with its quantitative easing more than anything else was to provide a covert bailout of the banking system. They used the weak economy as economic cover. As political cover. But the whole game here was to help the banks. Now, they did get off ground. They did raise interest rates a little bit. People are very nervous about the stability of the system around the world. I hear a lot of people talking about danger of deflation, danger of banking collapses, things like that. You may have problems in the banking system, but we had that back in 2008, and the reaction of the Fed and the rest of the world was not to let the system collapse. Rather, they intervened every way they could to keep it from collapsing. If we see something like that again.
So you think that they cannot raise rates anymore? Is that what you're saying? That the economy is so weak they can't? Go ahead.
They may raise rates, but if they run into trouble, which they're running into, the system runs into trouble, they're going to do everything they have to do to keep the system from collapsing. So it'll be providing more liquidity to the system. If anything, it's going to be towards lowering interest rates. And along with that, you should see some reversal in this tremendous strength that's been seen in the dollar. And that'll start to unwind all the craziness that's been seen in markets from gold and silver to oil.
Well, let's look back at what Canada says they're going to negative interest rates. Let's say the Fed says, okay, we're not going to raise any rates, or heaven forbid, or whatever, they come out and say, economy's so weak, we're going to cut that quarter point back. What happens to gold and silver and oil and commodities if they call a halt on their interest rate rises because the economy's weak, as you just pointed out, we're going to be in a recession, or they even go so far as to cut that interest rate back? What do you suppose will happen?
Well, they could cut back. I can't imagine they would go to negative interest rates. That's not stimulative to the economy. I don't think anybody would buy that domestically. The issue, though, the one reason that you have strength in the dollar is that there's expectation here that interest rates are still going higher. And back in the days when countries worried about having too strong a currency, if you wanted to manipulate your currency's value, the most direct and easiest way was to alter interest rate policy. You raised rates if you wanted to strengthen it. You lowered rates if you wanted to weaken it. The effect here is that the global economy, the global financial system, is in enough trouble that the central banks, including the United States, most likely are going to go back towards some kind of a salvage operation, which will mean not higher rates in the United States, which will mean a reversal in the dollar's strength. I mean, that's the primary prop behind the dollar, that and perhaps expectations that the U.S. economy is booming along. I can tell you the economy is not booming along. We're in what will become recognized formally as a new recession. And in terms of interest rates, in fighting that and fighting the instabilities in the system, they're still fighting the instabilities from 2008. That has not played itself out, and as it does, they're going to be flooding the system with liquidity. It's either that or they let the system fail. They decided in 2008 not to let the system fail. So that's as they flood the system with liquidity, you'll see weakness in the dollar, you'll see a return of inflation domestically, and all sorts of other factors rallying, such as the traditional inflation hedges of gold and silver, and even where we've had all these supply excesses in the oil market right now. The oil market's very closely tied to the dollar. If the dollar takes a significant hit, which I expect it will, that also will tend to put some upside pressure on oil prices.
Iran says that they're going to start really pumping out oil now that the sanctions have been lifted. Iran's oil is coming online, although their infrastructure is not very, very good, but they're still going to be pumping out more oil, and they can sell it to the world now with unfettered. The big banks have been, complaining that they're exposed to all this fracking and oil investment and all this stuff with a declining price. And Nomi Prinz was on and said, well, they're worried about defaults. They're worried about bond defaults, and they're worried about bankruptcies, and it's going to hit the banks. This is going to be? They say this is worse than subprime by an order of magnitude. Is this what you're talking about? That the banks may get into trouble again, and the Fed is going to pull the liquidity fire hose out and flood them with cash?
Well, that's part of it. The thing is, the system never got whole again. It never got out of trouble, and I'm talking on a global basis. They never resolved the problems that led to the panic of 2008. All the actions that were taken by the Fed, by the global central banks, were aimed at pushing the problem into the future. It's primarily looking at the United States, the Fed, and the U.S. Treasury. They couldn't let the banking system fail. But they did nothing, virtually nothing, to address the problems that led to the panic. And that ranged from, excess debt and credit. Some of that's been adjusted by the marketplace. Instabilities in the banking system. The banks are a little bit better, but they're far from stable. A faltering economy that never recovered. It bottomed out, and what we saw is that the economy plunged, and then in reality you had sort of a low level of stagnation. Now it's turning down anew. The federal budget deficit still out of control, and I'm not talking just the day-to-day games they're playing with the cash flows and the headline numbers, but with the long-term solvency issues of the United States. We have still on a GAAP basis, generally accepted accounting principles, overall obligations, net present value of unfunded liabilities and our debt in excess of $100 trillion. There's no way the United States can handle that in the current circumstance without taking significant efforts to bring things such as Social Security and Medicare into fiscal balance. And there's no political will at the moment to do that. Things may change down the road with a new government, but you certainly don't have it in place now.
Do you think, because this is an election year, that they're going to be even more, because Janet Yellen is a big-time Democrat. She was appointed by Barack Obama. Do you think they're supposed to be, I know they're supposed to be independent, blah, 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 but do you think in an election year that they'll have more propensity to turn the spigots on and try to flood the system if you think it gets into trouble? And you're saying right now you see clear signs the system is declining and going into recession, are they going to? Do you think they're going to pull the trigger on this soon?
Very possibly. Beyond normal politics, they're looking at survival of the system here, and they're not going to play games with that. If they have to do it to save the system, they'll do it to save the system. In terms of where you'd have political impact, raising interest rates, or even cutting them, right before an election, generally are not done. The Fed shies away from that so that it appears neutral going into an election. But if the system is in dire need of something, not that there's too much they can do, I expect they'll take whatever action they need.
John Williams, do you think that people are selling their bonds and covertly the government or the Exchange Stabilization Fund or the Fed is buying those bonds off the market to hold rates down? Because they raised rates a quarter, but the 10-year didn't go up. It actually went down some. So do you think they're covertly buying those bonds and removing them from the marketplace to hold rates down?
Well, they did that initially to hold rates down. That was what the quantitative easing was. They came in, they bought the bonds, and they hold 2.5 trillion or such outright right now. That's a major factor behind keeping rates low. It also, when they were back actively buying the bonds, and again, they're not selling them, they're just not buying them right now. The effect was they monetized 3/4 of the new debt issuance of the United States. If people aren't buying the treasuries, such as China, such as Japan, if they're selling, there's certainly been stories of that. The Fed's the buyer of last resort. So one of the byplays of quantitative easing, if they go back to expanding that, which would be my expectation in an effort to try and keep the system from collapsing, the effect would be to effectively monetize a lot more debt that's being issued by the U.S. government.
So you think the next step is they're going to be monetizing more and more debt. And then I want to bring this in. So that's the first question. You think they're going to be monetizing more and more debt because you think the system is shaky and we're heading into recession. Is that correct?
Yeah, well, and then along with that, the government is going to have trouble selling its funding needs, covering its funding needs. That has been a circumstance. And what happened with the quantitative easing last time round, although that was used as a prop for the banking system, again, it was also used to monetize federal debt. It eased the funding problems for the U.S. government. Who's going to be buying the bonds going forward? Good question. Quantitative easing takes care of that because the Fed can buy them. It turns the interest back to the government. It just holds them. But it buys them time. Problem is they don't have a solution. There's no way out of this for them. It does not have a happy ending. And as you go down the road, and as they move back towards a quantitative easing, again that will tend to debase the dollar, and along with that, all sorts of inflation problems that will come to play. But we're not there yet. It's at the moment they're moving away from that. Ostensibly, they're not selling their treasuries, but they have hiked rates. The story is they're going to hike rates again. It'll be difficult to do that if they move back towards quantitative easing, which I think they may be forced to do.
And you're in the hyperinflation camp. You've been calling for this since 14 and 15, and I know they've done crazy stuff. They've sold bonds in Belgium. They've done all kinds of sleight of hand. And the dollar has this been a conundrum for you that the dollar has actually strengthened and other currencies, gold and other currencies around the world? I had Rob Kirby on. He says in Canadian dollars, I've made money every time I bought gold in Canadian dollars. Around the world, the dollar is strengthening against the other currencies, but gold is strengthening against those other currencies. But is it imploding into us? Is this your conundrum that the dollar is strong and we haven't seen it at hyperinflation yet? And when do you think we'll see it?
Well, I did not expect the dollar to rally to the levels it is. It's still well shy of its all-time highs, but it's certainly the highest level we've seen in a couple of decades. And it's part of the controlled, very heavily intervened in system. And what's propping it fundamentally, to the extent there's anything that's propping it fundamentally, is number one, expectation of higher interest rates, and number two, I'm talking U.S. interest rates, and number two, still ongoing perceptions of a strong U.S. economy. The perceptions on the economy are beginning to falter, and you see some selling pressure when you get these bad numbers out time after time after time. What will happen at some point is the Fed's going to have to look to salvage the system again, as it did back in 2008, and with that will go the prospects of raising interest rates. We may see it just from the weak numbers that all of a sudden you'll start to see the dollar selling off very significantly. But the fundamentals here are very negative for the dollar, aside from, at the moment, the talk of higher domestic interest rates. As that disappears, and as you move back towards propping up the system, I would expect that you're going to see a very heavy sell-off in the dollar, resulting domestic inflation that will move on into eventually hyperinflation, but we're not there yet.
The Fed knows that things are spiraling downward. They must know that, right? Does that worry you?
I would assume so, but you can't be sure. I've known a lot of people in the economics trade in and out of government and private business. I find that most people in private business, when you talk with them, and they're not talking in front of shareholders, or they're trying to put forth a happy everything's fine and dandy picture, they know very well what's happening, and I assume they do in the Fed as well. But
in other words, they know the economy is your contacts that you do shadowstats.com for your clients, and they're big money, and I know it's a secret list, and they're big Fortune 500 companies and hedge funds. Your clients are telling you privately, we know the economy is tanking. Is that right?
I'm getting a lot of that, yes.
They're telling you that they're worried, and they see the handwriting on the wall that this thing is spiraling downward.
You don't have to be looking at your sales records to see that. It's surfaced now in a lot of public numbers, such as in production, such as retail sales. You're seeing the housing sector turn down again, and again, you look at the published numbers on corporate America, and revenues of the companies that are in the S&P 500, which is a cross section of economic activity. The revenues are down. That's your sales. That's the equivalent of your GDP. There's no way the economy's booming here.
Your clients are verbally telling you, when you've got them on the phone, they're worried.
I would say that most of the people I talk with are worried, yes. In fact, I have not come across anyone who isn't worried. But then, there's a certain bias in terms of what I have, and people will tend to seek me out more than, if I were forecasting that things are going to be booming along, I'd probably get some more of the boom crowd giving me calls.
And last question, how are your clients protecting themselves? I mean, what are they telling you that they're saying, okay, here's what we're going to do. We're going to go to cash, we're going to go to gold, we're going to go to land, we're going to pay off this. What are your clients telling you they're going to do to protect themselves?
Well, generally, it's it's a conversation that goes both ways, and what do we have to look for here in terms of when should we, batten down the hatches? There are people already battening down their hatches. They're seeing a weak economy. Others.
What does that mean, batten down the hatches? What are they doing to batten down their hatches?
Well, it's a matter in terms of internal operations, and maybe they have to cut back in certain areas, or they expand in different areas, look at different businesses. But with in the private sector, in terms of personal wealth, I've been bullish on gold as long as you've known me, and gold rose and it sank sharply, and right now it's still relatively low. But I've never been talking about gold in terms of day-to-day trading, and you buy it now and you're going to sell it in 6 months and make a big profit. the way I look at gold, the way I look at the system, is that we're faced with a crisis here that takes the system into a whole new realm. We're going to see a collapse of the dollar. It's taken a lot longer than I thought. I thought we'd have this in place a couple of years ago. The Fed has done things beyond what I expected. They've been able to keep the dollar propped higher. That's not going to last. I can't tell you just when it's going to break, but the economy should do that. And when it does, you will move towards that inflation. And whether you get gold at $1,000 an ounce, $5,000 an ounce, you got it at $2,000 an ounce or whatever, hang on to it, because that's what physical gold will preserve the purchasing power of your wealth and assets through what are going to be very difficult times still ahead of us. We've not been through the crisis yet.
Will silver do the same? People will be asking me. They're saying, "What about silver? What about silver?" So, what about silver? Will that do the same for people who can't afford, to plunk down $1,100 or $1,050 or $1,080, whatever it is, the price of gold?
Silver has the same concept. Gold is probably the primary one, but it's silver's right there. I mean, it's also a store of wealth. It also has a little more industrial use, which than gold does. But yes, I look at gold and silver together as precious metals and as hedges against the difficult times ahead.
And last question. And although I know timing is difficult because this is only the biggest calamity in recorded history, is that right? Is this the biggest? What's coming? Is that the biggest recorded calamity in recorded history?
Well, I'm sure there have been a lot of calamities in recorded history. It'll be the worst financial disaster of modern times, for sure.
Then my last question is this. When it finally breaks and we get this hyperinflation or a collapse in the dollar or a collapse in the system, whatever you want to call it, how fast will it happen? What do you think the speed will be?
Tough to say. I think the sell-off in the dollar can come very quickly, and it can happen at any time. And once that does happen, then you'll start to see inflation move. You'll start to see some general flight from the dollar, assets out of the United States. That's when you start to run into the risk of the hyperinflation. It's not likely that it's going to happen in a week or two, but once the process starts, I wouldn't want to bet on not seeing a pretty good rate of inflation within 6 months.
John Williams, shadowstats.com. How much is your subscription? You sell subscriptions too, just to normal people, to regular people, not just Fortune 500 companies and hedge funds. How much is your subscription a year?
$175 a year, and we offer it for 6 months at $89.
And I'll tell you, it's your reports are highly detailed and they're plentiful. You're a prolific writer. So thank you very much for coming on USAWatchdog.com and telling us what's going on in the real world with the real numbers in the economy.
Thanks for having me, Greg.